Hello. The annual report for DBS Group looks pretty hip these days, with a selfie by the senior management team featuring in the first part of the annual report, and also hashtags dotted throughout. An easy read even for Generation Y. But over the next couple of minutes, I'll take you through some of the salient points. It's no excuse not to read it for yourself, but at least to highlight some of the key things that you'll find in the 2014 annual report, including this map. China obviously has the biggest circle, but that's largely because of the population base of China. Sure enough, DBS is strongly represented in China, Hong Kong, Taiwan, and the other markets that you see there. But Singapore is still the most important market. As you see in this graphic on page 102, you can see 38% of their customers are incorporated or based in Singapore. And Singapore still makes up 62% of DBS's earnings, 30% in Greater China, and it's just the remaining 8% that come from countries like India, Indonesia, and some of the other representations that they have. So Singapore, still a very important market for DBS, a bank which is now worth more than $50 billion and having gone from 55th place back in 2008 to 44th place now in 2014. That's the 2014 financial year that we're reviewing here. The total shareholder return over the last 3 years, 94%. But as Piyush Gupta, the chief executive, acknowledges in the chairman and CEO's letter to shareholders, it was a tough year, 2014, not an easy year with interest rates remaining low. Singapore's housing was still hit by those property cooling measures, and there were some other specific notables, including a particular issue with the Qingdao port in China's Shandong province, which has been quite detrimental to a number of banks. DBS says that it was largely spared because of the way that it loaned money. There's also a very interesting interview, and before we cut to all the numbers, I just want to draw your attention to the interview that you can read for yourself, in which Piyush Gupta says that DBS is well protected against downside risks in the Singapore property market as those cooling measures continue to bite and interest rates remain low. He also points out that he doesn't believe that China's economy, although slowing and restructuring, will have a hard landing. At this stage, he says they're not seeing any unusual signs of stress across their China portfolio. Commodities, different story, that there will be a few bad hits in the commodities sector. But, as he points out, DBS has stress tested their portfolio and have found only a handful of potentially weak cases, none of which is likely to be material. What was most interesting, I found, in the interview were these comments about digitization. Digitization, says Piyush Gupta, is going to change banking forever. He says the digital revolution will fundamentally redefine the banking industry in just a few years because, as he puts it, banking is perhaps the most digitizable of all industries as we deal only in bits and bytes. It's only a matter of time, he goes on, before the disruption that the retail and telecom industries have experienced befalls banking. Very hard-hitting words. Monumental change is just around the corner, he says, pointing out that the biggest payment company in the region today is Alipay, an online payment platform, part of Alibaba. Alipay, not a bank. And this means that we are nearing a defining moment for traditional banks. Some will make the transition, he predicts, but many may not. Very hard-hitting words, I would say, and largely that's what we've seen then reflected in some of the numbers. For example, the cost-to-income ratio at 45% is pretty much where DBS wants it, but that doesn't mean that they haven't saved money. They have $500 million apparently, but that's been plowed back into additional staff and that digitization, which Piyush Gupta sees as so fundamental to the success, even the survival of the banking industry. He goes on to say that, we talk about credit risk and liquidity and all of those bread and butter issues, but in actual fact, it's digitization that you need to watch. As I mentioned, $500 million in cost savings plowed back into employee benefits. That's on this chart here. You can see salaries is actually up from less than 1.7 to almost 1.9 billion. And other expenses, we kind of look aside the other expenses because, hey, it's only the other expenses, right? Well, guess what? That's where a lot of the digitization expenses, that is the expenditure in order to digitize the bank and get it ready for the future, are housed. Look here, other expenses, computerization from 670 odd to 770 odd, even as rents and other things stayed flat. And so where and how are they digitizing? We're not getting anything specific, but we do get a few vague hints. Check out this quote here, this breakout. A partnership with IBM makes DBS among the first in the world to use artificial intelligence to provide contextualized and customized wealth advice to high net worth clients. Think about that. You're going to get advice from artificial intelligence on where to put your money if you're a high net worth client. That's being piloted this year. And a partnership with Singapore research agency A-Star is exploring emerging technologies that will simplify the lives of customers. Very vague, but obviously that goes to show how much effort they're putting into being at the cutting edge of this digitization process. By the way, page 138 if you want more information on those expenses. You also see dotted throughout the annual report little hints about digitization, like this little screen grab here, continue to lead in digital banking and payments. DBS Payla was one of those initiatives launched. Apparently they have 200,000 customers and 60,000 transactions a month. Here we are in another part of the annual report. Use the digital innovation as a differentiator to grow the regional SME franchise. You can see the signs of digitization are dotted throughout the annual report. Maybe that's why they're using so many hashtags to kind of connect with Generation Y. That's the digital generation. Page 28 has a quick summary of some of the other financials which I want to take you through. Income here, it says up 8%, but if you include one-time items, that is, net profit was actually up by 10%. Customer loans up 11%, customer deposits up by 8%. A lot of up. You can see that here in these in this 5-year chart, and you'll see that again in a few minutes. A quick note here on net interest earnings. Interest rates very, very low at the moment, as we know. They've been virtually zero for years. And what we're seeing here is the net interest margin continuing to creep up. So they continue to eke out profit from net income, from net interest margins, even though those interest rates are so low. Return on equity is at 10.9%. That's below the 12% that they're aiming for in normal interest rate circumstances, but as they keep pointing out, we are not in normal interest rate circumstances, which is why they're quite happy with the double-digit return on equity number. Net interest income, by the way, as you can see in this graphic here, which you'll find further back in the annual report, is largely from customer non-trade loans. Net fee and commission income was also higher there. We are looking once again one line item to break out there is trade and transaction services. That was actually down. That was one of the few numbers that I could see that had actually fallen. Page 137 if you want to look at that for yourself. A couple of other 5-year charts. SME banking income up 3%. Look at the fine print, but still up. Wealth income, more than $1 billion now, up 19%, maybe because of the bedding down of the acquisition of Société Générale, although that's the wealth management business. But DBS does point out that $220 million acquisition has given them, and obviously a big growth in this area, but actually getting new customers has been a little bit difficult. So what they're focusing on is getting more money from their existing customers. Transaction banking income up 9%. Look at that number, 1.6 billion. Look at where that came from back in 2010. And treasury customer income, again, 10% growth, again, almost double where it was 5 years ago. Credit risk, as this breakout says, is one of the things that they focus on most strongly, the most material risk, and incurs the highest usage of capital. So where's credit risk at the moment? Further down in that breakout, you'll read it. The Indian economy marked a second straight year of slow growth. Higher defaults was the result, higher delinquencies, constrained liquidity. India, fortunately, small part of the portfolio, but he says it's turning around. Allowances on doubtful debts. Again, look at this multi-year chart, and what we can see here, dating back to the second quarter of 2012, is that the non-performing loan ratio has trended down and is flattening, and you can see more breakouts of where money is owed to them. Page 144 has more details on who owes the money. Some specific allowances being made in the transportation, storage and communications business, a fairly sizable right down there. Remember that page number 144 in order to look that up for yourself if you're interested in that sort of thing. Page 103, by the way, has another chart that might be of interest because once again it shows where the non-performing assets, not non-performing loans, non-performing assets. And once again, we've seen a gradual trending decline since some fairly high numbers back in 2009. Page 90 for more details on credit risk. And here's page 113. I thought this was also very interesting because these two charts really tell a very different story. On the left, 2013, this is where most of their risk came from. That big increase in that big red circle in 2014 is from internal fraud, interestingly. Internal fraud. So a lot of the annual report talks about what sort of internal controls they've put in place, including a hotline where you can basically dob in a co-worker or a customer or supplier or anybody else who you as a DBS staff member thinks is not doing the right thing. So internal fraud seems to have taken up a very big part of this graphic, but again, they talk about how they're managing that. Industry concentration is important to know where some of their biggest exposures are. Page 82 is next as we wrap up our review of the DBS Annual Report 2014. This is where Piyush Gupta's salary is detailed. And the reason I pull this one up is because what you see here is it broken down in terms of where his salary comes from, where the bonus and other things come from to make up his $10 million take-home from 2014. So that's various initiatives, various ways that the chief executive gets paid. But below that, we're not seeing a breakdown in terms of what everybody else is earning. And DBS explains that although the Code of Corporate Governance and the guidelines recommend that at least the top 5 key executives have their salaries spelt out in bands of $250,000, as is quite customary among Singapore companies, the board believes that such disclosure would be disadvantageous to their business interests because the competitive conditions in the banking industry are such that there's a lot of poaching of executives. Poaching of executives is commonplace, therefore they're not going to disclose what the next 5 executives are going to earn after all. Somebody might go along with a higher offer. In total, though, they paid them in aggregate, the total senior management, $53 million. Curiously, when you turn to page 210 and you look at some of the resolutions for the AGM on the 23rd of April, the resolution number 4 is very interesting because it actually points to less money being asked of shareholders to approve for the remuneration of directors, down from $3.7 million down to $3.5 million. Page 210, and here are the details of the AGM for DBS Group.